You probably didn't notice it. Most people didn't. On January 13th, 2026, the United States Treasury held what should have been a routine auction. $39 billion in 10-year notes. Standard procedure. The kind of thing that happens every week in the vast machinery of American finance. But something was off. The auction tailed. Yields came in higher than the when-issued market expected. Primary dealers, the banks legally required to absorb whatever the market won't buy, had to step in and take more than usual. And in the quiet corners of finance Twitter, in the signal chats of macro traders, in the late-night conversations between hedge fund managers, people started asking the same question. What happens when buyers stop showing up? Because here's what they're not telling you. Here's what gets buried beneath the headlines about inflation cooling to 2.7%. And the stock market grinding higher and the Federal Reserve engineering yet another soft landing. The United States government has to refinance $9 trillion in maturing Treasury debt throughout 2026. $9 trillion. That's roughly 1/3 of all outstanding marketable debt. That's 30% of America's entire GDP. And it all has to be sold again. This year. And the people who've been buying it, they're starting to walk away. Have you felt it yet? That subtle squeeze? Your mortgage rate that still hovers near 7%, even though the Fed cut rates 3 times in late 2025. Your credit card statement that shows interest charges eating more of your payment each month. The job offer that never quite materializes. The raise that doesn't match what everything costs now. This is what it looks like when the bond market starts to break. Not with a bang. With a slow, grinding pressure that squeezes the life out of ordinary people, while the people at the top scramble to keep the music playing. Let me show you what's really happening. As of January 7th, 2026, America's national debt stands at $38.43 trillion. Let that number settle in your mind for a moment. 38 trillion. The debt increased by $2.25 trillion over the past year alone. That's $8 billion per day, $334 million per hour, $5.57 million per minute, $92,912 per second. Every single second. You can actually watch it happen. There's a website, the U.S. Debt Clock, where you can see the numbers spinning upward in real time faster than your eyes can track. It's hypnotic and horrifying, because unlike the abstract trillions that policymakers throw around in congressional hearings, unlike the sanitized charts in budget documents, this is visceral. This is happening right now as you're listening to these words. But here's what makes 2026 different. Here's why this isn't just another year of deficit spending and debt accumulation. Most of that 38 trillion isn't long-term debt locked in at stable rates anymore. During the pandemic, during the zero interest rate years of the 2010s, the Treasury went on the biggest borrowing binge in American history. And they did it smart, or so they thought. They borrowed short. Treasury bills. Notes with 2, 3, 5-year maturities. Because why lock in money for 30 years when you can borrow it for almost nothing over just a few? The weighted average maturity of U.S. debt hit 72 months. That's the longest it's been in 3 decades. The Treasury was proud of this. They called it terming out the debt. Sophisticated debt management. But here's what that really means. About 1/3 of all outstanding debt turns over every single year. When those bonds mature, they don't just disappear. They have to be refinanced, sold again, to someone, anyone. And here's the problem. The $9 trillion that's maturing in 2026, most of it was issued when money was free, when the 10-year Treasury yield was below 1%, when the Federal Reserve was buying $80 billion of bonds every single month, providing an endless bid, a buyer of last resort who never asked questions about price. That world is gone. Now that debt has to be refinanced at yields around 4.15%. Some projections suggest rates could push toward 4.5, maybe 5% if demand weakens further. Let me put that in terms that hit home. A 10-year bond that was issued at 0.5% in 2020 now has to be refinanced at 4.2%. That's not just an increase. That's an 840% explosion in borrowing costs. Do the math with me. $9 trillion. That's about half pass. If the refinancing rate rises even 2 percentage points from where that debt was originally issued, that's an additional $180 billion in annual interest costs. If it's 5 percentage points higher, that's $450 billion. Every single year. Forever. Or until the debt gets refinanced again at whatever rates the market demands then. $450 billion. That's more than half the U.S. defense budget. That's money that doesn't build roads or fund schools or pay for health care. It's simply the cost of having borrowed too much for too long. It's rent on past mistakes. And it gets worse. Because right now, interest payments on the national debt have already hit $952 billion in fiscal year 2025. Think about that for a moment. Nearly $1 trillion just in interest. That's the 3rd largest spending category in the federal budget, behind only Social Security and Medicare. In the first quarter of fiscal 2026, interest expense hit $179 billion, already making it the second largest expenditure, narrowly beating both Medicare and national defense. Interest costs are consuming 17% of total federal spending. They've more than doubled in just 3 years, and the Congressional Budget Office projects that, by 2035, annual interest payments will top $1.8 trillion. That's more than the government currently spends on everything except Social Security. Let me say this plainly. America is approaching a point where it pays more to service its past borrowing than it spends on its entire military. More than it spends on its infrastructure. More than it spends preparing for the future. The U.S. government is slowly becoming a giant interest payment machine with a country attached to it. And here's what nobody in power wants to say out loud. This only works if people keep buying the debt, if bond auctions keep clearing, if investors around the world continue believing that U.S. Treasuries are the safest asset on earth and keep showing up week after week, month after month, to absorb $9 trillion in 2026 alone, $10 trillion in 2027, and on into a future that starts to look less like managed decline and more like controlled demolition. So the question isn't whether America can afford to refinance $9 trillion this year. The question is, will anyone actually buy it? And at what price? Let's talk about who's been buying America's debt, because this is where the story gets dark. For decades, the answer was simple. Everyone, foreign central banks, pension funds, insurance companies, money market funds, hedge funds, individual investors chasing safe returns. The U.S. Treasury market was the deepest, most liquid market in the world. The ultimate safe haven. When crisis hit, when markets panicked, money didn't flee Treasuries, it flooded into them. That's changing. Let's start with the biggest players, China and Japan. As of March 2025, China's holdings of U.S. Treasury securities dropped to $757 billion. That's down from $784 billion the previous month, down from $902 billion in September 2022. China has been steadily, deliberately, methodically reducing its exposure to U.S. debt for years now. Some analysts estimate the real decline is even steeper when you account for holdings disguised through custodians like Euroclear. Why? Trade tensions? Sure. Geopolitical rivalry? Absolutely. But also something simpler and more rational. China is diversifying away from an asset whose return no longer justifies the risk. They're buying gold instead, lots of it, record amounts. Because gold doesn't carry counterparty risk. Gold doesn't lose value when the Federal Reserve prints another trillion. Gold doesn't depend on the full faith and credit of a government running $2 trillion deficits, as far as the eye can see. Japan, still the largest foreign holder at $1.15 trillion, has been a more stable buyer. But even that's shifting. Japanese institutional investors have started repatriating their U.S. fixed income allocations as interest rates rise at home. Why lend money to America at 4% when you can earn nearly that much in yen without the currency risk? Data shows Japanese investors have been net sellers of long-dated U.S. Treasuries through late 2025, particularly in the 10 and 30-year space. And here's the kicker. Even when foreign demand holds up, it's increasingly coming from the private sector, not official buyers like central banks and sovereign wealth funds. Since 2021, foreign public sector purchases have actually been negative to the tune of $107 billion. That's being offset by private foreign buyers chasing yield. But private money is flighty. It moves fast. It doesn't stick around when things get scary. Here's what this means in practice. For decades, the Treasury could count on a certain baseline of demand. Foreign central banks needed dollars for trade. They needed Treasuries as reserves. They were price insensitive. They bought because they had to, not because the yield was attractive. That created a floor under the market. That floor is cracking. If China accelerates its Treasury sales, if Japan's repatriation continues, if other foreign buyers decide that 4.2% is not enough compensation for financing, America's deficits, while watching the dollar as reserve status erode, where does that leave the rollover? It leaves it in the hands of domestic buyers. Pension funds, insurance companies, mutual funds, banks, and most precarious of all, leveraged hedge funds running basis trades, borrowing short-term to buy long-term treasuries and pocketing the spread. These are not stable long-term holders. These are hot money traders who will vanish the instant volatility spikes or margin calls hit. So when $9 trillion has to be refinanced this year, and the historical base of foreign demand is shrinking, and domestic buyers are already loaded up on treasuries from previous auctions, you start to see the problem. Supply is about to overwhelm demand. And in bond markets, when supply overwhelms demand, yields rise. Fast. Let me take you back to a moment that most people have forgotten, but that haunts every Treasury official who knows their history. 1976, the United Kingdom, a country that had won 2 world wars, that had built an empire spanning a quarter of the globe, that had invented modern finance and central banking, and the very concept of government bonds as we know them found itself unable to sell its debt. The British gilt market collapsed. Buyers disappeared, yields spiked, inflation raged into double digits, the pound plummeted. The UK government, humiliated, had to go hat in hand to the International Monetary Fund and beg for a bailout. The IMF imposed brutal austerity, spending cuts, tax hikes, the effective surrender of British economic sovereignty. This wasn't some banana republic. This wasn't a developing nation that had mismanaged its currency. This was Great Britain. And it happened because bond buyers went on strike. Or go back further. 1923, Weimar Germany. The government needed to refinance its war debts and reconstruction bonds. Buyers balked. The Reichsbank, facing a failed bond auction, made a fateful choice: print the money instead. Within months, hyperinflation destroyed the German economy. The savings of an entire middle class evaporated. A wheelbarrow of cash couldn't buy a loaf of bread. We know how that story ended. We know what came after. These aren't abstract historical curiosities. They're warnings, proof that even great powers, even developed economies, even nations with centuries of financial credibility, can find themselves suddenly, shockingly unable to borrow. And when that happens, the choices are all bad. You can let interest rates spike to whatever level attracts buyers, but that crashes the housing market, the stock market, the corporate bond market. It triggers a recession, or worse. It destroys the wealth of your own citizens to satisfy foreign creditors. You can impose austerity, cut spending, raise taxes, balance the budget the hard way. But that's political suicide in a democracy. No politician wants to tell voters that Social Security is getting cut, or that Medicare is being means-tested, or that taxes are going up 30% because we borrowed too much in the past. Or you can do what desperate governments always do when they can't sell their debt and won't cut spending. You print, you instruct your central bank to buy the bonds that the market won't. You call it quantitative easing or balance sheet expansion or emergency liquidity provision, but it's all the same thing. You create money out of thin air to paper over the gap between what you're spending and what you can borrow. And then you get inflation. Not the transitory kind that policymakers insist will fade. The persistent, crushing kind that eats purchasing power, that punishes savers, that transfers wealth from ordinary people to asset owners, that quietly robs everyone who holds cash, while the people who own real estate and stocks and commodities watch their wealth grow. The Federal Reserve knows this. Jerome Powell knows this. The Treasury Department knows this. They've studied the same history. They've run the same scenarios. They know that if the $9 trillion rollover fails, if auctions start tailing badly, if bid-to-cover ratios collapse and primary dealers get stuck with mountains of unsold bonds, they face an impossible choice. Let the market clear at whatever yield it demands and watch the financial system convulse, or step back in as the buyer of last resort, restart quantitative easing, and reignite the inflation they spent 3 years trying to kill. There is no good option. There's only the least bad option. And right now, watching the data come in, watching foreign buyers step back and auction results soften, it's not clear which option that is. Here's what makes this moment so precarious. It's not just the size of the rollover. It's the timing. It's the context. It's the web of interconnected vulnerabilities that turn a manageable problem into a potential catastrophe. Start with inflation. Yes, it's come down from the 9.1% peak in mid-2022. Yes, the headline number is 2.7%, but core inflation, the number the Fed actually cares about, is still 2.6%, still above target, still persistent, still showing up in services and wages and rent, the kind of sticky inflation that doesn't just vanish because the Fed wishes it would. This matters because the Fed can't just cut rates aggressively and backstop the Treasury market without risking a resurgence in inflation. They're trapped. If they hold rates high to keep inflation in check, they make the rollover more expensive and more difficult. If they cut rates to ease the rollover, they risk losing credibility on inflation and watching prices accelerate again. Then there's the fiscal situation. The deficit for fiscal 2026 is projected at $1.7 trillion. That's on top of the $9 trillion that needs to be refinanced. Total gross issuance for the year, over $10 trillion. $10 trillion of Treasury securities that have to be sold into a market that's already saturated, already wary, already demanding higher yields. And the deficit isn't shrinking, it's structural. Mandatory spending on Social Security and Medicare grows automatically as the population ages. Interest costs are compounding. Discretionary spending keeps rising. Tax revenues are strong now, boosted by tariffs and decent economic growth, but that's fragile. The instant growth slows or recession hits, revenues collapse and deficits explode. Meanwhile, the composition of the debt is getting riskier. 50% of outstanding debt is now in notes. 21% is in bills, short-term securities that mature in a year or less. Only 17% is in bonds, the long-dated securities that lock in rates for decades. This is the exact opposite of what you want when rates are rising. You want to be locked into low rates for as long as possible. Instead, the U.S. is constantly rolling over debt at whatever the current market rate is, perpetually exposed to every uptick in yields. And here's something most people don't realize. The average interest rate on total marketable debt hit 3.362% in December 2025. That's up from 1.552% just 5 years ago. As more debt gets refinanced, as more of those old 0% bonds mature and get replaced with 4% bonds, that average rate keeps climbing. Which means interest costs keep climbing, which means deficits keep climbing, which means more debt issuance. It's a vicious cycle, a debt spiral, and we're in the early innings. Then there's the geopolitical dimension. This isn't happening in a vacuum. The world is watching. America's adversaries are watching. They see the debt load, they see the deficits, they see the dependence on foreign buyers, and they're probing for weakness. There's a reason China is dumping treasuries and buying gold. There's a reason BRICS nations are discussing alternative settlement systems and reducing their dollar exposure. There's a reason central banks around the world are diversifying their reserves. They sense vulnerability. They sense that the era of American financial dominance, of the dollar as the unquestioned global reserve currency, might be entering its twilight. And if that perception takes hold, if the world starts to believe that U.S. Treasuries are no longer the ultimate safe asset, if the dollar's reserve status begins to erode, not in some distant future, but right now in real time, then the rollover doesn't just become difficult. It becomes a crisis. Because at that point, you're not just refinancing debt. You're defending the entire architecture of American power. Let me bring this back to you, to your life. Because this isn't some abstract macro problem that only affects bond traders and central bankers. This is about your mortgage, your credit cards, your job, your retirement, your ability to buy a home, start a business, send your kids to college, retire with dignity. Every single one of those things is priced off the Treasury market. When Treasury yields rise, mortgage rates rise. Right now, despite the Fed cutting rates 3 times in late 2025, mortgage rates are still hovering near 7%. Why? Because the 30-year mortgage is priced off the 10-year Treasury, and the 10-year is stuck around 4.15% because the market sees too much supply coming, too much debt, too much risk. If the rollover goes badly, if yields spike to 5 or 6%, mortgages could hit 8, 9, even 10%. At that point, the housing market doesn't just cool, it freezes. Nobody can afford to buy. Prices collapse, equity evaporates. Your home, your largest asset, loses value while you're still paying the mortgage on what it used to be worth. Credit card rates, already brutal. The average is over 20%, but those are tied to short-term rates. If the Fed has to hike again to defend the dollar or contain inflation from money printing, credit card rates could push 25, 30%. Suddenly, that balance you're carrying isn't a manageable burden. It's a trap. You're paying more in interest than principal. You're drowning. Corporate borrowing costs rise too. Companies that need to refinance their debt face higher rates. That means less money for expansion, for hiring, for raises. That means layoffs. That means the job market tightens. That means you have less leverage to ask for more money, less security if you lose your job, less opportunity to move up. And retirement? If you're holding bonds in your portfolio, rising rates mean falling bond prices. You take losses. If you're in stocks, rising rates often mean falling equity valuations, especially for growth stocks and anything leveraged. Your 401k takes a hit from both sides. The nest egg you've been building for decades shrinks just as you're getting ready to rely on it. This is the hidden tax of debt. It doesn't show up on your W-2. The government doesn't send you a bill, but you pay it anyway, in higher costs, in lost opportunities, in a future that feels smaller and more constrained than the past. And here's the cruelest part. The people who benefit from this system, who profit from the debt machine, aren't the ones who suffer when it breaks. They're insulated. They own assets that inflate when the Fed prints money. They have access to cheap credit before rates rise. They can shift their wealth offshore, into gold, into real estate, into whatever holds value when currencies debase. It's the middle class, the working families, the people living paycheck to paycheck who get crushed, who watch their purchasing power erode while being told the economy is strong, inflation is transitory, everything is under control. You feel it, don't you? That sense that the game is rigged, that the rules are written for someone else's benefit, that no matter how hard you work, how much you save, how carefully you plan, there's some force out there beyond your control, slowly siphoning away your future. You're not wrong. That force is debt, decades of it, mountains of it, debt that has to be serviced, refinanced, rolled over, again and again and again, at higher and higher cost, until something breaks. So what happens next? What does 2026 actually look like as this $9 trillion wave hits? The base case, the scenario that everyone in power is desperately hoping for, is that it just works. Auctions clear, yields rise modestly but manageably. Domestic buyers absorb what foreign buyers won't. The Fed stays on the sidelines. Growth holds up. Inflation fades. The rollover happens smoothly and everyone breathes a sigh of relief and goes back to pretending the debt doesn't matter. That's possible. The Treasury market is still the deepest and most liquid in the world. The dollar is still the global reserve currency. America still has enormous structural advantages. If you squint, you can imagine a scenario where this is just another year. A little bumpier than usual, but ultimately manageable. But let's be honest, that's not the most likely outcome. That's the hope, the prayer. The more realistic scenario is stress. Auctions tail more frequently. Yields grind higher, pushing toward 4.5, then 5% on the 10-year. Foreign buying stays tepid. Domestic buyers get choosy, demanding more yield to absorb more supply. The Fed finds itself in an impossible position. Either tolerate higher long-term rates and watch the economy slow, or step back in with quantitative easing and watch inflation expectations unhinge. In this scenario, mortgage rates push toward 8%. The housing market stalls. Refinancing activity collapses. Consumer spending weakens as people feel poor, as their home equity stagnates, as their debt service costs rise. Corporate earnings disappoint. Stocks wobble. Volatility returns. At some point, probably in the second half of 2026, the Fed blinks. They can't let the rollover fail. They can't let Treasury yields spike to 6 or 7% and crater the financial system. So they restart QE. Quietly at first, modest purchases, technical adjustments. But the market sees through it. The bond vigilantes see through it. And they demand even higher yields because now they know the game. The U.S. will print rather than default, will debase rather than discipline. Inflation starts ticking back up, not to 9%, but to 4, then 5. Enough to erode purchasing power. Enough to panic policymakers. Enough to make people realize that the inflation fight of 2022 and 2023 was not the end. It was round one. That's the middle scenario. Uncomfortable, costly, but survivable. Then there's the tail risk. The scenario nobody wants to talk about, but everyone in finance has modeled at least once in a late-night spreadsheet spiral. A major foreign holder, maybe China, decides to make a political statement and dumps a significant portion of their Treasury holdings all at once. Or a geopolitical crisis erupts, a conflict over Taiwan or in the Middle East, and suddenly U.S. assets don't look like a safe haven anymore. Or a major bank or hedge fund blows up on a leveraged Treasury position and has to liquidate hundreds of billions in a fire sale. Any of these triggers could cause a cascade. Yields spike 3, 4, 5 percentage points in a matter of days. Auctions fail outright. The Treasury is unable to place debt at any reasonable price. Margin calls ripple through the financial system. Liquidity evaporates. Credit markets freeze. At that point, the Fed has no choice. They go full Weimar. They buy everything. They print trillions. They backstop the entire Treasury market, the entire financial system, whatever it takes. And in doing so, they sacrifice the dollar's credibility. They sacrifice price stability. They sacrifice the store of value function that makes a currency trustworthy. In this scenario, inflation doesn't tick back to 4 or 5%. It runs to 10, 15, 20. Asset prices explode in nominal terms while purchasing power collapses. The middle class is obliterated. Social unrest follows. Political extremism surges. Everything we take for granted about American stability, about the normalcy of daily life, about the assumption that tomorrow will basically look like today, all of it comes into question. Is that likely? No, that's the tail. The 2% scenario, but 2% isn't zero. And when the stakes are this high, when we're talking about the stability of the global financial system and the reserve currency that underpins it, even a 2% chance of catastrophe should keep you up at night. Because here's the thing about tail risks. They happen more often than the models predict. Ask anyone who lived through 2008. Ask anyone who watched COVID shut down the global economy in a matter of weeks. The world is fragile, systems are interconnected, and the distance between everything's fine and everything's on fire is a lot shorter than people think. So what do? How do you protect yourself when the people in charge are piloting the system toward an iceberg they can see, but can't avoid? First, understand that this isn't about panic. This is about awareness, about seeing the machine for what it is and making rational decisions based on that reality. If you have debt, especially variable rate debt, pay it down aggressively. Credit card balances, home equity lines, anything tied to short-term rates. Because if the Fed has to hike again or if credit conditions tighten, that debt gets more expensive fast. You don't want to be caught in a vice where your monthly payments are rising faster than your income. If you're saving, don't just park everything in cash. Yes, money market funds are yielding 5% right now, which feels great compared to the 0% era. But 5% in nominal terms is maybe 2% in real terms after inflation. And if inflation accelerates, that real return goes negative. You're losing purchasing power even while your balance grows. Diversify into real assets. Not speculative nonsense, not meme stocks or crypto moonshots, but tangible things that hold value when currencies debase. Real estate, if you can afford it, and you're in a market with strong fundamentals. Commodities. Gold, maybe as a small hedge against monetary chaos. Not because you think gold is going to $10,000, but because it's one of the few assets with no counterparty risk, no reliance on someone else's promise to pay. If you're young, if you're building your career, focus on skills that will be valuable no matter what the macro environment looks like. Hard skills, technical abilities, things that produce real value rather than financial engineering. Because in a world of higher rates and tighter credit and slower growth, the premium for people who can actually build things, fix things, create things, goes up. And most importantly, stay informed. Not the sanitized headlines, not the official reassurances, but the real data. Watch the Treasury auctions, watch the bid-to-cover ratios, watch foreign holdings, watch the yield curve. Watch what the bond market is actually telling you, because the bond market doesn't lie. It doesn't spin. It doesn't care about politics or narratives. It just prices risk. And right now, the bond market is screaming that something is wrong. Let me tell you what keeps me up at night about all this. It's not the numbers. Numbers are just abstractions. It's not even the policy failures, the decades of kicking the can down the road, the bipartisan refusal to ever make hard choices. That's frustrating, but it's expected. Politicians are politicians. What haunts me is the silence. The fact that we're staring at $9 trillion in debt that has to be refinanced this year, at interest costs that are approaching $1 trillion annually, at a fiscal trajectory that is mathematically unsustainable, and almost nobody is talking about it. Not the mainstream media, not the politicians, not even most people in finance, except in private conversations where they can speak freely. There's this collective pretending that if we just don't acknowledge the problem, it'll somehow resolve itself. That modern monetary theory will save us, or technology will boost growth, or some deus ex machina will appear and make the debt disappear. But debt doesn't disappear, it compounds. And the longer we pretend it's not a problem, the worse the eventual reckoning becomes. I think about families, normal families. People who work hard, who save what they can, who play by the rules, who trust that the system is basically sound, even if it's not perfect. And I think about what happens to them when the bond market breaks. When their mortgage rate spikes and their home value collapses and their retirement account craters and their job disappears because their employer can't refinance its debt. They didn't cause this. They didn't vote for decades of deficit spending. They didn't lobby for tax cuts without spending cuts, or spending increases without tax increases. They were just trying to live their lives. And they're the ones who will pay the price. That's what makes this a moral issue, not just an economic one. Because the people who benefit from the debt machine, who get rich off cheap money and asset inflation and financial engineering, they'll be fine. They always are. They'll shift their wealth into whatever survives the crisis. And they'll buy the dip. They'll come out the other side wealthier than before. It's everyone else who suffers. The people who don't have accountants and lawyers and offshore accounts. The people whose wealth is their home and their retirement account and their salary. The people for whom a 10% decline in purchasing power is the difference between security and struggle. And here's the deepest irony. Those are the people who make the country work, who build things and teach kids and care for the sick and keep the lights on and the water running. They're the ones who deserve protection from this kind of systemic risk. And they are the ones who will get sacrificed to protect the bondholders and the bankers and the politicians who created the mess in the first place. So here we are, January 2026. The national debt at $38.43 trillion and rising by $92,000 every second. $9 trillion in maturities coming due throughout the year. Foreign buyers stepping back, domestic buyers getting nervous, yields grinding higher, the Fed trapped between inflation and insolvency. This is the moment, not some distant crisis that future generations will have to deal with. Right now, this year. These next 12 months will determine whether the rollover happens smoothly, whether it happens painfully, or whether it doesn't happen at all, and we lurch into some kind of crisis that makes 2008 look like a dress rehearsal. I don't know which path we're on. Nobody does. The variables are too complex, the interconnections too dense, the feedback loops too unpredictable. Maybe the Treasury finds enough buyers. Maybe yields stabilize. Maybe we muddle through and everyone forgets there was ever a concern. Or maybe we don't. Maybe this is the year when the music stops, when the debt finally becomes too much, when the bond market's patience finally runs out, when the choice between default and debasement becomes real and immediate rather than theoretical and distant. What I do know is this: the system is fragile. The margin for error is thin. The assumptions that have held for decades, that Treasury auctions always clear, that foreign buyers always show up, that the dollar's reserve status is eternal, all of those assumptions are being tested right now in real time. And if they fail, if even one of them cracks, the cascade will be swift and brutal and unforgiving, because that's how complex systems break. Not gradually, not with warning, but all at once. And by the time you realize it's happening, it's too late to get out of the way. So pay attention, watch the auctions, watch the yields, watch what the bond market is telling you, Because the bond market sees what's coming before anyone else, and right now, it's flashing red. The $9 trillion rollover is here. The clock is ticking. And whether you've noticed it or not, your financial future is hanging in the balance. I'll leave you with one last thought. There's a quote from Hemingway's "The Sun Also Rises" that gets used a lot in finance. A character is asked how he went bankrupt, and he answers, 2 ways, gradually, then suddenly. That's where America is right now with its debt. The gradual part has been happening for decades, the deficit spending, the accumulation, the promises made without resources to keep them, the slow, grinding erosion of fiscal discipline. But we're approaching the suddenly part, the moment when all that gradual decay reaches a critical threshold and the system tips. When bond buyers balk and auctions fail and yields spike and the Fed has to choose between catastrophes. Maybe it's this year, maybe it's next year, maybe we buy a few more years of can kicking. But it's coming. The math guarantees it. And when it arrives, it won't feel gradual anymore. It'll feel like the world turned upside down overnight. So prepare, learn, watch. Understand that the official story, the narrative of American strength and endless resilience and the inevitability of muddling through is just that. A story, a hope, not a guarantee. The $9 trillion maturing in 2026 is real. The bond market time bomb is real. And whether it explodes or quietly diffuses, whether we escape or pay the price, will shape everything that comes after. You've been warned.